We're going to talk Bitcoin. Take a look at where things stand right now. We want to talk about what's driving this because we're now back up at 96, almost 90, or 93, almost $94,000. This, of course, we were down, but 76,000 was maybe the recent low. I don't know.
76.5, yeah.
76.5. John D'Agostino is here. He's the head of strategy at Coinbase Institutional. Tell us what's going on in terms of the coupling, decoupling. I don't really know because there's periods of time where it feels very coupled, then it feels uncoupled, then it feels like it's coupled up again.
Right. Well, first of all, thanks for having me. It's great to be back on. So when we talk about decoupling, we're really talking about neutral to negative correlation. And more specifically, we're talking about negative correlation when markets panicking on the downside. Nobody minds correlation when it's upside correlation. So, first and foremost, got to be super careful, right? This is a relatively short-term data set, April. You don't want to assume it's going to persist. I could be making a fool of myself right now, and today it could jump to a 1 correlation. The other thing you want to be careful about is, even if we understood exactly the reasons, and I'll get into what we think they are, just because this occurred now, it doesn't mean if that similar set of events occurred, we'd have exactly the same behavior. So just a disclaimer, be very, very careful. And that applies to gold. That applies to any asset. So the nice thing about my position is I don't have to guess as to what traders are thinking. We're kind of the center of the crypto ecosystem. So when you called me, I made a bunch of calls. And the pools of capital that have been buying during April, sovereign wealth funds, large institutional, long-term duration pools of capital, they're looking at it basically 3 ways. One is, if you think about the tariff announcement April 2nd, if you believe that that's going to have a spillover effect on global trade, you believe there's going to be less global trade, then much of which is denominated in U.S. dollars, then you think there'll be lower demand for U.S. dollars, that we refer to as de-dollarization. Well, some of the ways Bitcoin is used by these large pools of capital is they buy it in their local fiat currency, they hold it, and they sell it into dollars when they need it. Well, if you think dollar is going to weaken, then you don't do that anymore. And so you're holding more Bitcoin. And these, again, large insurance pools, sovereigns, et cetera. So that's one thing, is this de-dollarization trade. The second piece is that post-COVID, Bitcoin kind of got caught up in this levered tech trade, kind of just bundled into the QQQ, bundled into NVIDIA. It's not really a tech stock, but it kind of got associated with tech stocks.
Well, was it? I always thought that the issue was that there were retail investors who were taking their winnings, in some cases, from an NVIDIA or a Apple or Meta, whatever, one of the Mag 7, and then moving it into Bitcoin. And therefore, then it was all tracking because to the extent that then they owned that other stuff too. Whenever it went down, they had to sell out of stuff. They also were selling out of Bitcoin.
During the bubbly periods in tech stocks, that's not an unfair assumption. But I'll note one thing. So for the month of April, as you would expect, gold ETF inflows were massive. I think $8.5 billion roughly from the 2nd through the 22nd. Might surprise you to learn that Bitcoin ETF flows were net negative to the tune of about $470 million. So the opposite of that was occurring. So institutions, sovereigns, patient pools of capital were piling in during April, which resulted in about a 13% increase in Bitcoin versus 10.5 for gold. And retail via the ETF were exiting. So you got to kind of ask yourself, what do the institutions know?
Were the institutions buying Bitcoin direct? And how many of them are now buying via ETFs or other forms?
Well, hard to say. They don't, especially the sovereign wealth funds don't report.
But you're also, I imagine, seeing the ETFs buying. Because the ETFs should be buying on a
in the last couple of days.
But the ETF should be buying on a relative basis on behalf of their customer base.
Right, assuming there were inflows, right? But the last couple of days, yes, we've had inflows. But still, as of yesterday, should change today, we've had net negative ETF inflows. So, so the first reason is de-dollarization. The second reason is this tech unwinding of this big levered tech trade and Bitcoin trading on its core characteristics, which, again, are similar to gold. You've got scarcity, immutability, non-sovereign asset, portability. So trading the way people who believe in Bitcoin would like it to trade. The last was, to me, the most interesting, which is I spoke to a couple of traders who said, look, if you believe these conditions, these de-dollarization conditions are going to persist, you're looking at gold, obviously, first and foremost, but maybe you missed out on that trade. You're looking at that rally and saying, I missed the boat on that. So what other assets could participate in that market panic long-term inflation hedge? When you do the work, there's a very short list of assets that mirror the characteristics of gold. Bitcoin is on that short list. In addition to the 4 characteristics I mentioned, its mining scarcity, its mining difficulty gets harder over time.
And you can add 2 or 3 more good things about Bitcoin that you didn't even mention. So, I mean, maybe it never is used to wire money or whatever you want to call it over to to the Far East or something, but you certainly can do it instantaneously, frictionless, right?
And you could do it overnight.
And you don't have to, in gold, I mean, you better, it's heavy, you better store it, you better insure it. I mean, there's a lot of things.
Portability is an under-looked at, it's under-emphasized skill asset. It's very, very hard to transport large amounts of cash. It's very, very hard to transport large amounts of gold.
Right.
You can't put $400 million of gold on a small disk drive, tuck it under your arm, and move if you need to.
Right. Someone said after gold moves, if Bitcoin starts moving, it'll move a lot more. Do you believe that?
So look, again, if you buy into this notion, and I know a couple of some of the best commodity traders in the world, and 5-6 years ago they thought inflation was going to persist and be an issue. And there's no perfect inflation hedge. We all know that. Nothing's perfect. So they created a basket. So they looked at hundreds of different assets and said, what's the best possible basket of commodities, real estate holdings, U.S. Treasuries? What does that look like over the next 10 years to be the better inflation hedge just holding a single asset? In every single one of their analysis, Bitcoin was top 5. So again, nothing's perfect. But as a basket to protect against market panic and inflation hedge, Bitcoin and gold go side by side.